Hey guys, Rick and Mike from Heirloom Wealth Management. Quick hits today. We are talking about discounted cash flow. So if you've ever sat with us, you've probably heard us talk about discounted cash flow. That refers to the amount of cash in the future and how we think about it today. Mike, how would you describe discounted cash flow?
Yeah, I get all excited when we start talking about discounted cash flow evaluation because for me, it's a universal approach to valuing any investment, a bond, a stock, a piece of real estate that you're going to collect rental income from. The discounted cash flow process works for all of these types of investments. And basically what we're looking at is forecasting into the future, the cash flows that we expect, the after-tax cash flows that we expect to receive as part of owning this particular asset. Now, the thing that we need to do is when we look out into the future, those cash flows, we need to do what's called discounting them back to a value today. This discount mechanism accounts for both time value of money. The further out into the future it is before we get that capital, that cash flow, the less valuable it is. So we want to take that into consideration and also the risks associated. So the higher the risk associated with the investment, the higher the discount rate would be as well. And so the thing that we try to focus on forward looking is investing in businesses, real estate, that we have a high degree of certainty or at least a range of outcomes where we can say, hey, this is what we expect from a cash flow standpoint. This is when we expect to receive it, and then discounting it back to today. What do we think that that's worth? One thing that's important to also comment on here, and we talked about balance sheet in a prior video if you've seen that. When we're looking at a stock, for example, we would want to add a positive net cash position. That's cash that we already, when we buy the stock, or have a right to ownership today, or subtract a net debt position. So I can remember at one point, even in the last year, a company that you're probably all familiar with, like Alphabet, Google, as it's more commonly described, was delivering a free cash flow yield, which is essentially the net income. You've probably heard of that, or profit that it generates. You add back the non-cash charges like depreciation, subtract any fixed capital investment so that the business continued to operate and grow, any working capital investment that they need to make. And that gets us the free cash flow from the business per share was about 7%. Moreover, they had about 9% of the value of the business in net positive cash on the balance sheet at that time. So for us, that is an excellent opportunity to invest that we're looking at from a forward-looking discounted cash flow standpoint was really attractive. It's just one example. But the other thing that I would point out, and I mentioned this earlier, but a bond, we look at, here's the amount that I'm lending. This is when I'm going to get the bond maturity value back. Here are the cash flows intermittently. That's how we would discount that back for a piece of real estate. Here's what I'm going to buy it for. This is the rent that I'm going to collect, yada, yada. And then what is it worth today? Now, the last thing that I would add here is that when we examine investments that don't generate a cash flow, it's much more difficult to value. So when someone asks us, what do you think is gold worth? What is Bitcoin worth? What is a collectible worth? Because it doesn't generate any cash flows, we can't apply this process. And so really what we're doing is we're speculating on what somebody else might pay us for that in the future. That's much more difficult. It's not to say that it's not going to make money in a speculative sense, but it's difficult for us to forecast because we're trying to determine how people are going to feel about that in the future rather than what kind of cash flows is going to generate for us. So
yeah, earnings calls, those quarterly earnings calls are great. It's like, hey, here's what we did. That's rear looking, and a lot of those earnings calls will then have a projected forward or a look forward. So you might have a company that just had a killer quarter, blew out everything, but their cash flow in the future or their prospects for the future might not look as good, and the stock will tank. So the market, and we for sure, care a lot more about what's coming up in the future. And discounting cash flow and working back into that's really the best way to kind of look into the future if it's possible at all. So
yeah, and I've always been leery of driving in the rearview mirror, so to speak, when it comes to investing. And there's a lot of products out there, particularly in equities, exchange traded funds, mutual funds, that use backward looking data to determine what they want to own moving forward. And to me, that's just a backwards way to invest.
It's going to be difficult. So subscribe below, find out when we get updates out to you, and we'll talk to you soon. Hey guys, if you like that, click here or here to see other videos that we've recorded, and we'll see you soon.